Hello, everyone. Welcome back. And today we're going to talk about something very exciting, and I'm going to break it down in layman's terms because this subject is not easy to understand. So we can talk about how to, if you are a very high W2 income, if you make six figures, whether you make $1 million or $500,000 a year W2 income, I'm going to show you potentially if you follow the right strategies using income property, real estate how you can drastically reduce your taxes. And not only that, buy a listed portfolio accordingly, then not only can you reduce your taxes to a very minimal, but you can increase your wealth exponentially into the future. Anyway, my name is Seewing Yee. I'm a real estate wealth advisor. I run a real estate investment club here in San Francisco Bay Area, and it's called Real Estate Network. And we have several thousand so-called free membership of people that watch our free training on a weekly basis, video newsletters, the whole 9 yards. And of course, Julie is one of our very good member within our networking organization. As a matter of fact, Julie, many of you watch our joint podcast weekly basis. I appreciate you guys watching us every week. And Julie is one of the best members that we have. She has purchased a total of six rental properties out of state several years ago. And her portfolio have done very well for her. Long-term cash flow appreciation, very minimal maintenance, turnkey, just you sleep nicely, peacefully every night, and mailbox money just automatically come into your right?
That's the best part.
Yeah, that's the best part. Yep. Yep. Make money while you're sleeping.
Absolutely.
Yeah.
Mhm.
All right. So without further ado, so let me share my screen and let's get this going. I'm not sure how long this is gonna take. We can try to limit to like 30 minutes or so, maybe slightly longer, but it takes time to explain this kind of complicated subject matter. But by the way, we are not, Julie and I, we are not licensed tax
Right.
advisors. So we're just giving you some education information and always consult with your financial professional to go over your unique personal situations. However, since Julie and I are hardcore real estate investors, we know something about taxes. We know enough just to get into trouble. No, just kidding. All right. How would you like to? Okay, let's proceed. I'll just get on with this. Get on with the show. All right. All right. Hold on. Hold tight. Hold your horses. So how would you like to reduce? By the way, again, Julie and I have a lot of training over the years around real estate taxation. So again, we're no expert by any means, but we discuss these based on a high level. All right. And when you replay this video, just replay it until you understand it. And then if you guys are ready to go, get yourself a team of reputable tax advisors, CPAs, and asset protection attorneys, and your real estate wealth advisor, me, to help
Mhm.
work as a team to help you build your real estate portfolio and substantially reduce your federal taxes so you can make money for and work hard for you instead of work hard for your money. All right. So
Yeah.
here we go, Julie. Of course, anytime you want to interject, of course, I will give you the opportunity to get your input as well as we move along on this presentation. So if you are a highly compensated individual, doesn't have 300 to $500,000 W-2 salary, could be a million, whatever your W-2 income, you could be making less than $300,000. This is appropriate for you. All right. And of course, as you could be a healthcare professional, you could be a doctor, physician, or highly compensated self-employed individual, engineer, whatever managerial types, whether you live in Silicon Valley, by the way. Physically, I'm based in San Francisco Bay Area. I've lived here for several, numerous decades. And of course, and Julie, you're from Southern California. Both are,
My whole life.
yeah, wow, how nice. What a paradise, right? But
Yes,
yeah,
absolutely.
yeah, but very expensive housing market, as we all know, when you do your real estate plan the right way, and we can show you, you can do very well financially for the future. If you're making this six-figure income, you're going to be paying approximately 37% of your hard-earned money in total taxes. If you live in California, add on additional 12 or 13% California state income tax, which is almost more than half. almost half of your W-2 income, you have to pay Uncle Sam and the state of California. That is a big ouch, isn't it, Julie?
It really is. It really is.
Yeah.
Oh
Yeah. There's a way.
my god.
Yep. There's a legal way you can reduce your taxes accordingly if you follow the rules, if you're willing to sacrifice, if you willing to do whatever necessary to follow the rules and hire some great tax experts. And
Right.
can be done because Julie, I helped several people in this scenario over the years achieve
Mhm.
this kind of strategies. Okay. So
Right.
done this, we have done that. We have the resources, we have the properties for me to implement all the whole 9 yards, right? One stop shop. Okay.
Mhm.
All right. So you want to reduce your taxes down to 10 to 50% at our federal tax bracket, maybe even zero. Imagine, okay, this is not a too good to be true scenario. Like this is real
Right.
stuff that have done by others before you. So there's a track record there. All right, I'll get the nitty gritty. You know what's so funny, Julie? When I watch over the years, when I watch other by real estate experts and to talk about this subject matter, the one thing I found very interesting and troubling is that the way they explain it on a YouTube video with CPAs that specialize in these strategies, they don't know how to explain it the correct way. They,
Interesting.
they use too many technical jargons where
Oh, right.
what a layman simply does not understand. So
Right.
I know what's going on, right? I understand it. And so you and I will do our best to create a terminology on these
Mhm.
average folks out there can hopefully understand. All right. Okay. Again, uh, listen very closely to you guys out there, right? The best case scenario is for someone to become a quote unquote real estate professional. And I'm not
Right.
talking about you don't have to be a licensed little realtor. You don't have to use an exam. The IRS definition of real estate professional established section 469 of the IRS code
Right.
is a very unique terminology. You can be anybody. In fact, if you earn very high income, if you buy right amount of real estate to depreciate all these kind of items, all you have to do is, if you're single and working full time on your own, you will not qualify as a real
Right.
estate. Pro. But if you're single, you might want to get married. See, you might want to find a significant other. If you have a significant other, have that significant other to work part time, 15 hours,
Right.
or a better yet, a non working spouse that will at least 15 hours per week in real estate activities. And if you qualify under this rule, you could become the IRS definition of real estate professional tax status. Julie, you have anything
Mhm.
else to say before I go to the next slide?
I think that's a great example, particularly if you're more hands-on involved in your real estate investment business. And in fact, you were the first one that I had heard talk about it, and it was very intriguing when we first started on our real estate journey. So, yeah, I'm interested to hear more.
Julie, yes, I know a lot of people, a lot of savvy, experienced real estate investors do not understand this as we speak,
Mhm.
right? So
Right.
the way I'm not gonna, I don't want to sound arrogant or whatever or overconfident, but the way I explain on this presentation, the words can come out my mouth is very powerful, is very simplistic, and is in layman's terms. So
Right.
just I will prove it to you for the next 30 minutes or more. Right? Okay. All right. So real estate investing, when you buy income property, by definition, any kind of income you earn from your cash flow, whatever, is by
Right.
the technical definition is a passive loss.
Right.
Normally, all the depreciation and cash flow income can only offset by other passive losses.
Right.
This is a very important distinction. Okay. And so, for example, let me go over this rule. If your adjusted gross income, single or married, is $100,000 or less, you can write off depreciation, passive losses up to a maximum
Mhm.
$25,000. Okay.
Right.
And to against your active income, against your W-2 income and other household income. If your adjusted gross income is between 100 and $150,000, you have some, you can have passive write-off.
Mhm.
Dollar you make above and beyond 100,000, there's a 50% phase out for every dollar over
Mhm.
that grant. I know that's a little bit complicated, but just bear with me, okay? And
Right.
if you make more than $150,000 of adjusted gross income, you will not get any kind of depreciation write-off because all
Right.
your, but you should still claim depreciation on each of your income property,
Mhm.
but the depreciation and passive losses on a given year will be suspended and carried forward into subsequent years to be used to all those accumulation of passive losses to be used in the future once you unlock your tax status to become not passive. All right. Follow me,
Right.
Julie? So far?
Yes, I totally get that. That makes
So
sense.
yeah, some of you guys are saying, "Oh, especially a lot of our investors, Julie, are in California, and they
Right.
easily make more than $150,000, right? They make
Yeah. Yes.
150, 300K, 500K, whatever." And you
Mhm.
might want to say, "See, Wayne, well, in that case, since I'm not going to get any kind of depreciation write-off or passive loss write-off, I might as well not invest in real estate." No, that's not how it works. Julie
Right.
explained. Try to answer these objections.
I think that you have to look again, it's always at a long term. Anything you do, in particular, if you're going to consider yourself a real estate investor, you can't always look at what's happening right now, this minute. There are a lot of benefits that do happen right now, this minute, but then there's a lot of benefits that will take place in the future. So I think any of your clients that are looking at investing, this is not a fix and flip mindset.
And you make your money. You and I talk about it many times, right? How many different ways you can make money using your income property? What kind of
Oh,
money can you make?
was up, didn't I? Can you hear me now?
Yeah, yeah, yes,
Oh
yes.
my goodness. Yeah, I just noticed I don't know if you heard anything I
Oh,
said.
everything's fine. Yeah,
Oh,
I can.
okay, good. Yeah, because I had frozen for a minute. I'm like, oh my gosh, did he get any of that? Okay, but I'm back now.
Okay, it's okay. Okay, all right. This slide, same thing. Okay, just to reiterate what we discussed on the
Right.
previous slide.
Mhm.
All right, so let's go on. Okay, here's the bottom line. And like I said, the other YouTube videos you might watch, other reputable CPAs that talk about this tax status, that they will spend hours and the technical jargon just go over your head, right? But
Right, right.
um, break it down to the nitty gritty on layman's terms. Like I said, become or marry a risk professional, and it's under the sections 469 of the tax code.
Mhm.
Okay. And if you unlock all the passive losses you have, if you want to have your passive losses, aka depreciation, paper write-offs, to offset against your active income as opposed to against your passive income, that can potentially drastically reduce your taxes, right?
Absolutely. Absolutely. Yes, yes.
Okay, the next few slides can be very technical. I'm not going to spend too much time on it. Again, once you replay the video, you can digest each slideshow and do whatever additional research you want to do. Beyond that, of course, at the end of the video, if you have not already done so, put your email into my website and below this link, this video, so you can become a free member of our real estate investment club. So you will be seeing additional information about all aspects of real estate education, including the topic we are discussing today, right?
Correct. Correct.
Step to qualify as a quote unquote real estate professional. Again, you don't have to have a real estate license. That is there's a misconception. So
Mhm.
step one is one spouse alone can qualify. If you're single, you full time, you cannot qualify as a quote unquote real estate professional uh,
Right.
because I'll tell you why. Okay, so that is step two. You have to,
Mhm.
the rules are you have to work at least 750 hours in real estate trade or business, 750 hours per year,
Okay.
which equate to around 15 hours per week. Ever, that's the very important thing is if you're working 40 hours full time, if you're single, and for example, if your spouse is working full time also,
Mhm.
you do not, you cannot qualify for this pro because you will, because your total work hours, your full-time hours will exceed 50% of the total work time that you require to, for you to perform the
Right.
750 hours in real property or trade. All right.
That does make sense. Okay. Yeah. It's really a good strategy, particularly if you are a stay-at-home spouse. And it would be a great way for you to really get more hands-on in the business and take advantage of the tax benefits as well.
Exactly. 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 Okay. Step three, again, is I'm going to break down these technical terms in a very simplistic way. At least I'm going to
Mhm.
try. So the step three, yeah, step three, this is the important definition, material participation. Okay. Material participation, again, gotta be 750 hours. Or, there's some additional requirement, which material participation means you have to perform the duties. You have to be very actively involved in the management and the performing of all the activities on your subject income property you have on your portfolio. You cannot, by the way, one additional distinction, you cannot hire a property manager to manage your rental property. Guess why? I'm gonna answer this question, Julie. Why you cannot use a property manager? When you do,
Right.
you do not qualify. Why is that, Julie?
Right. They're doing all the work that you would be doing as the real estate professional. They're doing I was going to say hiring, but they're doing the interviewing of the candidates, bringing in the tenants, handling all the paperwork, handling all of the rental receipts and all that. So they are doing the majority of the work that as a real estate pro, you would be doing that yourself. So yeah, you don't get to have it both ways.
Exactly. So even though, look, Julie, you and I, we have this business model where we have a lot of out of state properties by passively, long
Mhm.
distance, remotely. And many of our hundreds of our investors have done that over the years.
Correct.
Hire professional property management. That's fine, but there are ways you can still self manage out of
Mhm.
state remote properties. And there are ways, a lot of people are doing that. A lot of people self-managing their out of state properties. So they can do it, you can do it. So don't worry about it.
Oh, absolutely, absolutely. My
Yeah.
husband's uncle, he does it. I mean, he has the money, he has the flexibility, he has the time because he's retired. So he can fly back and forth to the different states and do that.
Yep, that's right. Okay, that's a more, yeah. So again, I'm not going to go over these technical rules, but you can read it on your own. But I think we cover all the important stuff. I want to go one little, I'm going to go off the presentation a little bit. Okay. So far, we've been talking about long-term rental property, right? Find an income property and rent it out for annual lease, a long-term tenant, if you will.
Mhm.
But there's another rule. I don't want to discuss it too much. I can spend a whole 2 hours to talk about a short-term rental tax loophole, if you will. But
Right.
but along, if you have the ambition, if you after watching this podcast, folks out there, again, you qualify, right? If you qualify, in addition to buying a number of long-term rental properties, you could
Mhm.
also buy a income property where you can do a short-term Airbnb methodology, right?
Right.
Yeah, some of you are good about it. Short-term rental tax loophole. I kind of do not like to use the word loophole. Loophole sounds like you want to circumvent the IRS. You want to
Right.
scam them, whatever. No, it's a legal strategy that's been used by a lot of our short-term renters in Airbnb world, what have you. So let's do a recap, Julie. Okay, real quick. Okay, I don't want to spend too much time on this matter.
Mhm.
If you want to, or if you find a way to acquire a short-term rental Airbnb, if you rent a property an average of 7 days or less
Mhm.
at any given time, if you material participate in the management of your short-term rental and you're not hiring a outside professional property
Mhm.
management, that is, you can offset your passive losses on this subject property against your income.
Right.
I want
Right.
you to start. So this short-term rental tax loophole is not a real estate professional tax status. All right?
Mhm.
It's a
Mhm.
totally different strategy. Why? Because short-term rental is a hospitality business.
Oh, interesting. Okay.
Yeah, you in the hotel, well, not hotel.
Right. Oh, yeah, like a hotel business. Yeah.
Yeah,
Oh,
you
that's
know how to tell the
so
business.
you actually because you're more hands-on, it's considered active business, right?
Yeah, I'm not going to get into details because by IRS definition, short-term rental is active business. You're no
Right.
longer a passive real estate investor. If you
Mhm.
look, if you buy income property and you have a property management and manage it for you, that is called passive rental real estate,
Mhm.
right? But a short-term rental is no longer passive. It's a passive business, active business that is. If you material participate and go to this rule, and then when you file your tax return, it's on the Schedule E. Schedule E is profit and loss. You no longer are filing your tax return on the schedule E. Schedule E is a supplemental income
Mhm.
schedule, which applies to long-term income property buyers, right? Rental tax.
That's correct.
So yeah, Schedule C is like a self-employed. You just self-employed active.
Right.
So again, if you qualify under this rule, all the depreciation, all the write-offs, all the expenses you incur in the material participating in the short-term rental or,
Mhm.
or offset against your W-2 active income. That's how you unlock all those paper losses and expenses to potentially reduce your working income. Does that make sense, Julie? Have
Right.
anything else to add?
Absolutely. It makes total sense. It makes total sense. If you think about the strategy of the short-term rental, you're gonna be much more hands on that. Like you said, it's almost like owning a hotel or an Airbnb or something like that. So, yeah. Mhm.
One. Again, I'm not saying that everybody can do long-term rental, whether it's locally or out of state. It's not that
Right.
easy. Some people doesn't have the mindset or the skills or the stress to buy a short-term rental and
Mhm.
self-manage, right? It requires so much effort and dedication and commitment.
Mhm.
Uh,
Impatience.
yeah, and not everybody's cut out to be a real estate
This
investor,
is very
for
true.
that matter, whether short-term rental or long-term rental, right? Am I right?
Exactly. I appreciate you saying that because I think some people look at maybe what other people are doing and they'll be like, oh, that's so easy. That's so simple. You just get a property and you rent it out a bunch of times or whatever. But it's a lot more to it. And I think going into this or anything where you're really self managing the business, you really have to understand that there will be issues and problems that come up. Nothing that's insolvable, but don't get disappointed the first time something comes up.
You experience what I've experienced. We have several thousand members within my own organization, and
Right.
we promote out of state turnkey, hands off, passive investing for our
Right.
investors. And yet, I've been telling you, only a minute percentage of our members are
Right.
willing to become a long term investor out of state, even though,
Mhm.
even though we have done all the research and
Right. Yes. And once
get
you
it.
get it, once you get the property, it is so seamless. The way we're doing it, we have property manager, very different than what you talked about. But it really, I say this all the time. I forget that we own property until the rent check comes in. It's like, oh yes, we're investors. So once you get it, but you've got to be willing to push through. If there's, don't get frustrated or upset with the first thing that doesn't go the way you anticipated because that's just the nature of the beast. But if you just push through, you will be able to reap the benefits, either with, being the real estate pro or just being a long distance investor like what I am.
Exactly. Sounds good. Okay, let's get back. Let's get back to the now. Again, once and if you become a real estate professional, tax status, manage self-managing long-term rentals, or do the short-term rental tax loophole status, a lot of people don't know this rule:
Mhm.
cost segregation and bonus depreciation. Normally, when you buy an income property, especially 1 to 4 unit, you can so-called depreciate your property over 27 and a half years, right?
Correct.
If you buy a $100,000 property divided by 27 and a half years, you can depreciate the paper write-off, by the way, paper tax write-off. You can depreciate like $2,700, right?
Mhm.
Per year.
Correct.
$100,000 property
Mhm.
divided
Yes.
by 27 and a half years equals
Right.
2000. That $2,700, you can write off, you can depreciate against your active income, as long as you make, 100 grand or less, as I described earlier on the earlier rule, right?
Right.
Now,
Exactly.
a lot of
Exactly.
people don't know, again, if you qualify for the short-term rental tax loophole, or you qualify to become real estate tax professional, you can further do a cost segregation and bonus
Mhm.
segregation. That means you don't have to go through your 27 have you divided by the cost of your property. I know that you have to minus 20% of the value of the house, the land. Yeah, I know.
Right.
I don't want to go through too much technical details, but let's try to use simplicity. But that's a lot of things that are attached to the house or not part of the permanent fixture. You could, when
Right.
you do a cost segregation bonus depreciation, you could take out the appliance, the landscape, or the backyard, the
Mhm.
items inside, the boiler, the electrical system. You could
Mhm.
do an accelerated depreciation, 10-year, 5-year, and 3-year depreciation acceleration write-off. That is a
Right.
cost segregation.
That makes a lot of sense.
Yeah, so it's an engineering study. You have to hire a cost segregation specialist to
Mhm.
pay them whatever money, $1,000, depending on the value of the property.
Sure.
You have to make sure that the property is valued. You can get the tax write-off more than the cost of paying a cost segregation expert to pay them to do
Mm.
this kind of status. But if you're able to do that, oh, by the way, the current law is that you can only deduct 60%. You can only use 60% cost segregation. But the
Mhm.
Congress, there's a good chance the Congress will change the rule. They can give back
Mhm.
100% cost segregation. In fact, you can do a backtrack the prior year once the Congress officially changed the rule back to the 100%
Right.
cost segregation write-off. Right now, we get 60%, and if the Congress does not amend the rule, 60% write-off cost segregation this year, next year will be 40%, the following year,
Mm.
percent, then the following year will be zero.
Oh, wow.
But there's a lot of hope that Congress will change the rule back to
Right.
100% cost segregation write-off. All right, so at the end of the day, I don't want to go through the details, but well, if you do the cost segregation from a high level, you can write off around 30% of the property. 30%
Mm.
cost segregation write off. Okay. I'm gonna give you a simplistic calculation. So if you buy a property for 775 thousand, for example, around multiply by 30%. My numbers could be off. Okay. I don't want to mess up my brain doing
Sure.
calculation. It don't take forever. For $700,000 property, you can write off probably cost segregation wise at least 100 grand on paper
Right.
to offset against your active income, W2 income. Right? So what I should say is a very amazing reduction. Okay.
Mhm.
Okay. Now and then, okay. So some of you can be asking, oh, what kind of property should I buy? What's the optimum way to buy the property to have best kind of write off? And here's the answer. Okay. We, as Julie, we have a networking relationship with many turnkey providers out there in different part of the US where you can buy this turnkey handoff new construction property with property management if you want, but you can self-manage if you want to apply to the tax rule. But you have to have enough high level properties in order to write off enough depreciation passive write off to offset your high income. Does that make sense what I just said?
Yes, it does. It does. I
Yeah.
totally understand what you're
Yeah.
saying. Mhm.
Although you could do that, I wouldn't want you to, the higher the value of property you own, the more depreciation cost segregation write-off you have to offset against your high six-figure W income,
That
right?
makes sense.
So
Mhm.
if you were to buy small cookie cutter property in the Midwest, like in Buffalo or wherever, for
Right.
$100,000, $70,000, although it's a good idea to
Mhm.
buy income property in such a small amount, but the depreciation on the lower value property, you're not going to achieve the maximum depreciation benefit.
Right.
So therefore,
Right.
correct, correct me if
That
I'm
makes
wrong,
mhm.
you should buy several multi-units, right? And a decent
Absolutely.
price.
Mhm. That makes sense.
Yeah. And here's my recommendation, right? Potentially, okay, you can do whatever you want, but my recommendation is, okay, I had to make the assumption if you make 300K, 500K, $760,000 W-2, if you're a
Mhm.
physician or engineer or a highly compensated individual and you qualify to the based on what we presented, uh,
Right.
let's say you have six or $700,000 of cash available
Mhm.
to
Mhm.
finance at 25% down payment to buy some of these multi-units. Does that make sense?
Yes. Yes, absolutely.
Yeah,
Great deal. That's a great deal. I'm just
yeah,
kind of fast forward into the numbers. I don't want to steal
yeah,
your
yeah,
thunder, but that's
yeah.
a great deal.
Exactly. You buy a brand new fourplex in a very fast, a hot market, one of the fastest growing market in Texas, for example. Again, I'm not going to discuss the local market conditions videos that
Mhm.
you and I have done on a weekly basis in the past. Watch my YouTube channel or become a member of our real estate investment club by putting your email at the on my website at the bottom of this video. Okay.
Mhm.
So anyway, this amazing fourplex in South Texas, you can buy 4 units. Okay, it's a quad, 545K. We put 25% down payment. Even at today's elevator rate, 7%, a little bit more. Yeah.
Right.
Total down payment, including closing costs of 150 grand. You finance it because the rent income is so high, the whole 9 yards. You have net positive cash flow and $773 and all 4 doors. Or I wanted this also. Right. So all the metrics looks good. That's your then when you buy a 525K property, you minus 20% for land. So 80% are depreciable, 80% multiplied by 54. 545, you're talking 400 something thousand dollars. Out of the 400 something thousand dollars, you do a cost segregation, you can achieve $80,000 of bucks cost segregation write off against your WGE.
Nice.
Those kind of
Very.
loans. Plus, we're achieving so much cash flow, so much appreciation potential, so much everything, whole 9 yards, right?
Oh,
So
yeah.
it's the
Great deal.
and also don't restrict yourself to fourplex. You can buy a 6 unit, which is this is the actual 6 unit
Okay.
available as well, or 10 units, right? Long you have
Mhm.
to do so. The higher the multi-unit value of the property, the higher the depreciation, passive losses, the higher
Mhm.
the cost segregation you can achieve maximum. So in this sixplex, brand new, very good market, very good location, great tenant, again, similar to the previous fourplex. But
Right.
this time, this brand new sixplex is 600 grand. Again, a lot of depreciation potential to unlock as well. Then you diversify into another location, which is in Florida.
Yes.
You know, again, this is our network, our turnkey provider that have this kind of turnkey ready to go brand new units that cash flow very well. They're excellent rental market, very fast growing, the whole 9 yards. So you buy these fourplex and brand new at diversified into another location, 800 grand, have a very good rental income on all four
Mhm.
doors. You put in my
Nice.
20% down payment. In this particular instance, you can get a buyer's rate buy down for 4.75% mortgage rate, which is
Right.
amazing. So you can cash flow very significantly. In this case, $1,000 net monthly cash flow and the whole 9 yards. So this is our typical sample portfolio you
Mhm.
can purchase. Okay, you can buy 2 or 3 of these multi-unit, 4 units, duplex, or 6 unit. Then you have tremendous amount of depreciate write-off, and you make 300, 400, 500K. That can substantially reduce your federal tax bracket. Uh,
Mhm.
all the tax savings you can obtain from becoming
Mhm.
a professional. You can offset buy more property with tax
Exactly.
requirements, and then get cash flow appreciation. The tenants paying off your loans for you on multiple
Mhm.
money. So at the end of the day, to recap, I've done this for almost 40 minutes. But yeah, this is one of many ways to do it. So hopefully the recap is this strategy is real, has been done. We have done it on behalf of our
Mhm.
investors. We had the team to do it, myself and my team, tax advisors, others, probably now may or may not be property managers in your case. So Julie, what's your takeaway?
It's interesting. I'm just listening. This is just another aspect of a benefit of owning investment property. And I think there was a lot that you had, spoken about in in the context of the lesson. But it's so interesting because it's not just like even like the last few units that you showed, you're not just getting the benefit of the depreciation, and the active losses, or the passive losses rather, and then the cash flow was phenomenal on those properties. So you're benefiting. Yeah, I will just say this. There's no downside to owning the property. Maybe that's a better way of putting it. Yeah, there's no downside. There really isn't. You benefit all the way around.
Yeah, I totally agree. Anyway, hopefully, as I promised you, out there, you guys are watching, I've tried to present it in layman's terms because if you have a real CPA or tax advisor or attorney try to explain this concept to you, I assure you, more often than not, it can go over your head because they
Right.
don't know, because they're because those financial professionals are trained in such a technical ways, they just
Mhm.
don't know how to relate to the normal people
Exactly.
out there.
Exactly. Yeah, I agree with you 100%.
Yeah,
Yeah, no, and it was good. It was a great overview. I like you said earlier, we're not tax professionals. Definitely get with your tax person so that they can really explain it the best they can, but here's the thing, they'll be responsible if they mess up.
that's right. Yeah, it's all on you, right? You will have to have
Right.
patience, you have to sacrifice, you will have to dedicate yourself to achieve wealth in whatever way possible. Even if you do not qualify for as a professional at this current moment,
Right, exactly.
nothing wrong with buying real estate so you can achieve your wealth for yourself and for your family. Julie,
Can't go wrong.
yeah, exactly. Thank you so much, Julie,
Thank you.
for hosting with me, and hopefully you guys receive a lot of value out there. If you did, please like and subscribe to my YouTube channel. And finally, if you have not already done so, put your email at the bottom of my website link so you could become our free member of our real estate investment club. So you'll receive weekly in my inbox on many aspects of those investments, not just what just put for me. All right. Thank you so much for watching. This is Seewing Yee and my co-host, Julie. Thank you so much. Have a nice day.
Thank you.